joining us now. An exclusive interview is Bank of America CEO Brian Moynihan. Brian, a very good afternoon to you. Thanks for joining us.
It's nice to be here, Wolf. Thank you.
Brian, lots to dig into on the PPP, which we'll definitely get to in a moment. But if I may, I wanted to start on the broader economy. We've been debating all week what the likely shape of recovery is. And I know at Bank of America, you have a sort of clearer pulse check on exactly what spending is looking like for corporates and for consumers. And I wondered what insights you could share with us on that front.
Sure, Wolf. It's a pleasure to share some of the insight we get from our 66 million consumers and our tens of thousands of companies. But before we do this, we always got to remind ourselves this is a human crisis and a medical crisis, and that can resolve. You'll see the economic situation get better. What we're seeing in the spending today, when we talk about consumer spending, we're talking about consumers' use of money, not only debit and credit card spending, which you get from Visa and MasterCard and people like that, but also the broader ways consumers spend money. So year-to-date is actually flat to last year. It was growing in the upper single digits, almost 10%, and then fell. What we're seeing very recently is the last 4 weeks, the run rate of that is about $50 billion a week of total cash moving through consumers' accounts to pay bills, to take out the ATM and spend, to use their debit and credit cards. That's about what it was in the fall of 2017. And it's kind of hit a flat there, and it's starting to grow a little bit. And so the good news is, given all that's gone on, it came down about 30%. It's kind of hit a flat space, and you're seeing it grow. But the aggregate amount of activity is more consistent with the fall of 17. If you took the 4 weeks in a row and took the average about 50 billion and went back and found when was the last time 4 weeks in a row it ran at a 50 billion average, that was then, and the economy was in reasonable shape back then.
So, Brian, are you suggesting, from what you said there, am I reading this correctly, that even though the rebound might be much slower than the fall was, that we have picked up a little bit and that the trough, as it were, of consumer spending may be behind us?
Well, it all depends what happens next. But right now you're seeing, yes, you're seeing some things start to go up. You're seeing retail, which was about 3 or 4 weeks ago, was all about provisions, people running out and grabbing everything they needed to be in a stay-at-home posture. What you're seeing that now is round out. They're seeing spending on clothing start to pick up a little bit. You're seeing spending at restaurants actually grow the last few weeks, both the quick service and regular restaurants off that lower base. And you're seeing, frankly, even just going to the theme of the day, you're seeing gas purchases at pump, both on our merchant side, meaning, when we process for the gasoline providers, and also on the consumer side, on the cards they use, you're seeing that grow a little bit. So what you're starting to see is, frankly, people probably are driving a little bit more now that we're 4, 6, 8 weeks into some of this activity. And so if you look at it, you're starting to see those things spend. Obviously, things like travel and movies and things like that are still, and you've had lots of guests talk about that, are still in a different condition. But you're seeing that. And even when you look at the communities that are opening, it's still premature because it's only happening now, but you're seeing the start of a little bit more spending in some areas and some of the states that have opened up a little bit. So we'll see where that leads us because it's still pretty early on.
Let's touch a bit on the PPP program, if we may, Brian. Those statistics that you were kind enough to share with me a few hours ago, 98% of your PPP loans to companies fewer than 100 employees, 76% fewer than 10 employees. There's been a lot of criticism of this program. Do people need to take a step back, look at those figures and realize that in general, it's sort of working, it's sort of fair?
Yeah, so let me just talk about where we are today, because this has been a heck of a week in the history of the PPP, from the reopening Monday morning to where we are here as we close the 4th week of the program. And so if you look at where Bank of America is now, the SBA working posture this week started off a little tough, but has improved dramatically. They processed a lot of activity. They've done a good job of getting their system up so you can send more through, and also the batch process you heard about. But we now have 231,000 plus SBA numbers today. That's 231,000 businesses of the profile you talked about. 98% less than 100 employees, 75 or 6% less than 10 employees have promissory notes going out to them. We'll send out over the next 48 hours probably 180,000 promissory notes to those businesses, totaling $15–20 billion. And so the program worked this week well. The numbers were staggering. That's 231,000 pieces of of work that went on to get through all of the process, and that's all going out. And the notes are out. We got about 50,000 notes are out already. The rest of them will go out over the next 48 hours. Those customers, all they have to do is execute the note, execute the documents, get it back to us, and the money goes in their account relatively quickly.
Brian, I know you can't touch on individual clients, but clearly there have been some cases where maybe because of the client's size, its strength of balance sheet, or its access to other forms of cash, where they've tapped the PPP program, but perhaps were less deserving of those funds than other smaller businesses. Were there any examples for you where people met the written down criteria, but you guys looked at it and thought, this client isn't really as deserving as some might be, but you had to fund them either way because the terms were the terms?
I think through the frequently asked question guidance of Treasury, you've seen people take action, customers take action. It's not our responsibility, obviously, the customer's responsibility, and so you've seen that. But I think you get into the ins and out of all that, you're missing the broad point that we have 231,000 businesses for $24 billion, so an average of $100,000 a business less, and another 37,000 we have ready to go through the SBA. They're going through $1,500, $1,600 an hour. For another couple $2 billion. It is a broad-based program. It's going where Congress wanted it. The changes to the program that were made to eliminate the types of things you're talking about, you've seen the stories out in the public domain about it, but the reality is this is going exactly where it was supposed to go, to very small businesses in big numbers across the country.
Do you think the DOJ's opened some proceedings to investigate whether there was any fraud in the process? Do you think it is inevitable there will have been some fraud?
I'd let those investigations bear out and see what customers and clients doing. It's premature on all that.
The PPP program, Brian, clearly aimed at helping the smallest clients, and big companies, particularly with some of the Fed actions, have been able to tap the bond markets. The Fed's Main Street lending program designed to address the sort of middle ground of that. Do you think that has been well designed such that all the companies out there that need funding will ultimately be able to get that? And does it give you confidence that the level of write-downs you had to make in Q1 earnings will be the peak in Q1?
Well, let's just go back and think about when we're talking about the economy broadly, Wilf, to start. What you're going to see now as it plays out over the next several weeks here is the impact of these stimulus plans all hitting at once. So you're having the PPP program. You've seen some of my peers and ourselves talk about how much is going out the door relatively quickly. You have the unemployment insurance benefits that are now being distributed, even though the horrible situation with unemployment at the level it's at. You have the stimulus checks, of which hundreds and millions have gone out, and we have a major part in distributing those. So all that is hitting, and at the same time, you've seen what's the other thing the Fed has done is the Fed has stabilized through their standby, which is their role, and they've done a great job going really asset class by asset class in the market to stabilize. Treasuries, mortgage-backed securities, munis, and they've gone down those asset classes, and you've seen the spreads come in the regular way activity go up, which has allowed for tremendous issuance of investment-grade debt. The biggest month in history is April, and it was only the next biggest was March. So that activity has put a lot of liquidity in the market, a lot of activity, which has helped move a lot of the loan demand to the most stable long-term holders of that. And so you put all that together, where haven't they reached yet? Well, that's what Main Street has set up next. And so the teams from all the companies have been working with the Fed, and they've got a term sheet. And the good news is there. How it will be used? Frankly, the best news is it's never used, which means the economic recovery is such that we don't have to use it at all. But having it there for that asset class, which is hard to get to, is the right thing to do, and they've built the program, and we'll see it play out over the next few months as to what actually happens.
You mentioned, Brian, there where unemployment numbers are with the jobless claims. It's probably, most economists estimate, somewhere between 15 and 20%. Yet, as we stand here, the NASDAQ is give or take flat year to date. Do you think there's a risk in the months ahead that this is going to be seen as a set of bailouts or aid programs from the government and central banks that has really benefited Wall Street, the haves, and not Main Street, the have-nots, such that there'll be real implications for the shape of capitalism as we know it? Well,
I think in the end of the day, companies have to run their business to meet all their stakeholders. And you've seen a group of us sent a letter out from the World Economic Forum that talked about in the COVID crisis, how you think about stakeholder capitalism. We're all committed to it, most large companies. So what does that mean for us on our employee base? No layoffs this year. On our employee base, additional compensation for the teammates. They're doing a great job of serving America every day in the branches and staying open. And our employees, the availability of teledoc and free medical services and things like that. We probably have almost 300,000 days of child care that we're paying for so far to help make sure our employees can actually be effective when they work at home, when their kids are out of school. And you just go through all the different things that we've done. And I think employees like ours and otherwise are doing that. So no layoffs. We went to $20 an hour in March, and then all the other programs I just described is a heck of a package to tell to our teammates. We need them to be successful. We need to be successful for our shareholders. We need you to be successful, and the way we're going to do it is keep us safe, number one, and number two, make sure you don't worry about things that can help serve these clients and customers. Think about the amount of teammates, 10,000 or so, that are working on any given moment on PPP, who've been working every weekend, 24/7, volunteered from other lines of business to move over. Several thousand moved into this effort just to get it through in 4 weeks' time from the first application till now. And that's tremendous. And so I think the companies that run this way, which are a lot of large companies, we're trying to meet all the stakeholders, clients, customers, teammates, communities, $100 million in charity we gave, plus trying to deliver for the shareholders at the same time.
Could, Brian, one area that's got some focus, could mortgage rates and should mortgage rates come down a bit more than they have? They haven't tracked one for one the Fed's moves in interest rates. So is that an area that should and could happen soon?
Well, we're still doing about $1.5 billion mortgage volume a week still, so it's there. I think people have to be careful that just like spreads widen out when base rates fall, the idea of taking on a 30-year obligation by investors is not high when it's a mortgage that could extend all the way to 30 years. So it'll settle in, but there's lots of volume going on out there every day. And I think one of the interesting things that you guys talked about on one of the parts of your show today or yesterday is the housing market's going to be interesting now as you start to see real estate practices open back up or be deemed essential and the activities start to take place, and we'll see how that plays out, but that'll start driving the activity that will produce volumes of mortgages. Right now, they're the lowest in history, and it's a good deal for the consumer.
Brian, I wanted to ask how you're thinking about buybacks in the long term. Not so much whether you should be doing shareholder capital returns or not, but the balance between buybacks and dividends. I mean, clearly a lot of stock has been bought back by many companies, including your own, over the last couple of years. Were 2019's buybacks for Bank of America, for example, a mistake, given that it was done at a much higher share price than we're at today?
Well, then the question where 2018's a benefit done at a much lower price or 17. So that's always going to be judged. We don't think you're not trying to get return here. You're just reducing you're taking capital that you don't need to serve your customers and clients, and you're putting it back in hands of the shareholders to do what they need to do with it. Our philosophy has been to keep the dividend payout ratio below 30% of our earnings. That served us well in the first quarter because we earned more than twice our dividend. And the ability to continue to do that shows you how much earnings power we have in the company, but more importantly, how conservatively we've managed and brought the dividend up, even increasing it year after year for the last 5 or 6 years. So we'll continue to buy our stock back because in the end of the day, that is capital that we're generating that we don't need to support the business. And this past quarter, we grew $150 billion in deposits and $70 billion in loans, and think about $70 billion going out to corporate America and corporate world, helping them. We have all the capital we need to serve the customers.
And still a very firm commitment, Brian, to the current dividend.
Yes.
Wanted to touch on a broader question about U.S. government debt. There's been some talk over the last couple of days that one potential way to punish China would be to cancel their holdings of U.S. debt. Hypothetically speaking, if that were to happen, what would be the market reaction?
Well, I think the U.S. is the reserve currency and the most powerful economy in the world. So I think in the end of the day, we got to handle ourselves well and show the world what they should do. So I'll leave that to the politicians. But we have a great country and a great prospect, and that's why everybody in the world's putting money here right now.
So it would be a mistake to take that tactic.
I think the subject to negotiation with China is a political matter, but I think as a fiscal matter, our debt is part of our full faith and credit in the United States.
Brian, I wanted to just quickly touch on the potential long-term implications of some of the changes we've seen. You guys have a large portion working from home. Jess Staley, the CEO of Barclays, suggested having thousands of people in a single building might be a thing of the past. Do you think that's the case, that your long-term prime commercial real estate needs as a company will reduce?
Our needs as real estate were coming down just because in the end of the day, the digitization, the trend that has nothing to do with this virus, this tragic virus, but actually has to do with what was going on, continues relentlessly, so we can do more business with less human content, and we manage that well. That'll continue, so we'll have less real estate demands. I think, like anything else, I think the view of what will happen, because people are people, and consumer behavior that we see is consumers are creatures of habit. 20, 30 years ago, I'd sit with people and they said there'll be no branches in 20 years. Well, guess what? It's 30 years later and we still have 4,300 of them. So, a lot of people's views of how behavior changes, whether people want to come to an office. Right now, they'll have a viewpoint. A year from now, they'll have a different viewpoint. And you really have to think about it. After 9/11, people were afraid of flying for a while, but then TSA came in and the safety ensured this, and that's what it's going to take to get people back to thinking, which is what are the safety measures, what are the capability of handling similar outbreaks like this in the future, and that's what I think government and businesses like ourselves have learned a lot that will continue to apply in future cases that will assure our teammates they're safe. And so I think they'll come back to work. I really don't think working from home, even though we're doing it flawlessly, even though we took 180,000 people and did it, even though we deployed 100,000 laptops, even though we have people who are working from home that we never thought would work from home, the reality is we're more effective for the customer when we're in those buildings and doing it. So I think that'll happen. How we'll do that in the exact pace and the method we'll do that with is all subject to determination, literally floor by floor, function by function, person by person. And it'll take us a while to kind of get there, largely because we have to get past the point where this virus cannot hurt people through a vaccine to be actually the ability even to decide we're back to normal.
Brian, just quickly to round things off, was there a moment in March where some of your colleagues pushed the balance between getting people back for full effectiveness versus safety of workers a little bit too much? I'm sure you saw my colleague Scott Wapner's story based on a recording of your head of equities, Fabrizio Gallo. Was there a mismatch for a moment there in March in terms of what some of your deputies were telling their deputies?
I think at the end of the day, we've handled this very well for our teammates, and I've got 200,000 plus people I'm responsible for every day, and my management team is responsible for every day, and they all have access to me to express any concern, and we take care of that. And so the best thing we did is we took about 9,000 high-risk people out of the business, took them home immediately, even though a substantial part of those teammates have been home since then without an ability to work because, let's say, it was a branch manager and you can't manage a branch if you're not there type of thing. So we've handled it well. And so if any employee has an issue, they can come forward and ask me about it. And I'm happy to answer it. But the team's done a great job, Sherry Braunstein, our HR team. And think about the repositioning of that many people that fast, and yet with the highest market volumes ever, our tech and operations groups with the highest market volumes ever, and not having any issues of closing and even closing a quarter in the middle of it. It was unbelievable execution by the team.
Brian Moynihan, as always, a pleasure. Thank you for joining us.
Thank you.
The Chairman and CEO of Bank of America, Brian Moynihan.